today, credit up, prices up. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, it's the last day of the month today, so we got the latest statistics from the RBA and APRA relating to credit. And the ABS also gave us some information to digest relating to building approvals and the proportion of businesses who are going to put their prices up in the coming months. More inflation ahead, methinks. So today I want to take you through the stats fest for the last day of the month. And let's just start with the financial aggregates for February. This is from the Reserve Bank. And the first point to note is that credit for housing continued to boom, up 0.6% in the month, compared with 0.7% in January. So strong, but not quite as strong. But the annual move at 7.8% is considerably higher than a year ago at 3.8%. Personal credit also didn't change at all in the month and is still slightly lower than it was a year ago, whereas business credit is now very strong, up 9.8% over the last year and up 0.8% in the month. So signs that credit continues to move forward. Now we can look at the information in more detail. Now let's start with the monthly aggregates. These are always noisy numbers, but nevertheless gives us quite an interesting point of view. Housing was up 0.61%. Within that, owner occupation was up 0.73%, which you can see is slightly lower than last month. And investment was up 0.37%, still growing, but not quite as much strong as last month. Personal credit was just slightly down. Interesting to see it going up and down quite a lot, but I would highlight the fact that in the last couple of months there has been more demand for personal credit. This is because households are getting into more financial stress. The business investment's up 0.82%, which is pretty strong, of course, and I would highlight again, though, up 0.82%, but not as strong as last month. Now we can also then look at the total aggregates. All credit was up 0.65% over the month, and the broad money was at 0.32% higher over the month. Let's switch to the annualized story, and you can see that housing overall was up 7.8% over the last 12 months, now stronger than it was some time back. Owner occupation at 9.89 is incredibly strong, much stronger than in 2016. APRA, you need to tighten the rules, methinks. Investment lending at 3.98 is still moving up, but is still significantly below where it was in 2015. Personal credit was down 3% over the year, so you can see that after a considerable dip through September 2000, the rate of slowing has actually eased back. Business credit at 9.85% is incredibly strong, in fact stronger than way through the last few years. And I will just look at the all credit number 2 at 7.95%. You can see that this is moving very strongly. So this is a credit driven recovery. And broad money, though, is still stronger at 8.84%. That, of course, is all the money sloshing around the system. Expect more of that because, of course, the government's just announced the budget, and that included more payments for households. Now, I will just draw your attention to the 3-month trend as well. Housing 1.98% higher over the last 3 months, has tailed back slightly. Owner occupation at 2.38, tailing back slightly. And investment lending at 1.22%, slightly weaker. So it looks to me as though the numbers now are on the turn. And with housing prices looking as though they will ease back ahead, I wonder whether we've seen the peak of credit. We'll see. Now let me switch to APRA, the monthly authorised deposit-taking institution statistics. So this gives you the data for the banks. And looking at the owner-occupied lending, it was at 1.14% over the month. Investment lending was up 0.63%, so both quite strong. And overall lending for housing up 0.97%. That's remarkably strong. So the significant note here is that the banks are lending very hard at the moment. And that takes us to a considerable growth in both owner-occupied lending and investment lending. But actually, the proportion for investment purposes at 33.88% continues to drift lower. So we're still seeing owner-occupation lending stronger than investment lending. And overall, the total outstanding, this is loan stock, so this includes new loans written, loans repaid, and loans refinanced, at $1.961 trillion, getting very close to that $2 trillion. And if we look at the individual portfolio movements, we can see that CBA has predominantly been focusing on owner-occupied lending, whereas Westpac has dialed back its investment lending. National Australia Bank and Macquarie have grown their investment pools quite strongly. And ANZ has increased their investment footprint slightly, but continues to drift lower on the owner-occupied side of the equation. But I'd also highlight that the Bank of Queensland and Members Equity has significant movements. That's because, of course, Members Equity is now part of Bank of Queensland and is reported in the aggregate numbers, which is why I held them out and showed them separately, because Bank of Queensland had an increase in its portfolio of more than 25 billion, whereas Members Equity, of course, will disappear. So now let's turn to building approvals, which came out today from the ABS. The ABS said the total number of dwellings approved rose 43.5% in season-adjusted terms in February. That followed a 27.1% fall in January. They said the large rise in the total number of dwellings approved in February was recorded across all dwelling types. Private sector dwellings, excluding houses, rose 78.3%, following a 43.3% fall in January. The rise in February was driven by a large increase in apartment approvals in New South Wales and Victoria. Private house approvals also rose in February, 16.5%, following a 16.3% decline in January. Across Australia, the number of dwelling approvals rose in Victoria, up 91%, New South Wales up 48.8%, South Australia up 35.9%, Tasmania up 12.2%, and Western Australia up 8%. In season-adjusted terms, Queensland fell 14.6%, having been the only state to record a rise in January. And approvals for private sector houses rose in all mainland states, with New South Wales up 27.2%, Victoria up 20.1%, Western Australia up 11.5%, South Australia up 7.6%, and Queensland up 6.4% in seasonally adjusted terms. And the value of total building approvals rose 67.5% in February, and the value of non-residential buildings increased sharply, up 132%, following a 37.2% fall in January. And the February result was the second highest recorded behind March 2021 and was driven by a large number of public developments, with 14 projects valued over $30 million. And the value of total residential buildings rose 38.7%, comprising of a 47.7% increase in the value of new residential buildings and a 6.4% fall in alterations and additions. And the ABS also reported today that over the next 3 months, 39% of all businesses expect to increase their prices more than usual, according to the data from the ABS. Nearly all businesses anticipating price increases, at 97%, said that these were being driven by rising non-staff related operational expenses. These included rising fuel and energy costs at 88% and increases to the cost of products and services used by the business at 88%. The ABS said by industry, results showed that 59% of retail trade businesses expected their prices to increase more than normal over the next 3 months. The construction at 58% and manufacturing at 55% industries were the next most likely to expect price increases. The results also provide information about overall changes in business operation expenses. In March 22, 2 in 5 businesses, or 40%, had their operating expenses increase over the previous month. This compares to just under a quarter of businesses at the same time last year, when it's 24%. And when considering future operating expenses, the results show that more than 1/3 of businesses expect to see these increases next month, 35%, compared to approximately a quarter of businesses in January at 26% and February 23% of this year. Just thinking about these statistics, the dwelling approval numbers wobble around all over the place, up and down each month, but the trend is quite interesting, and specifically the approvals for units and high-rise apartments, of course, they're modular, and therefore you often see one approval, meaning that you get a lot of units. On the other hand, when it comes to business costs and business prices, it's quite clear to me that this is going to feed further into inflation. So once again, standing back, credit is up, inflation is higher, and building approvals are continuing to suggest more momentum in the construction and property sectors. What could possibly go wrong? And finally, I'll just draw your attention to the latest CoreLogic data. They've reposted their index in the new format. They've highlighted that Sydney prices went down a little more today. Over the last quarter, Sydney rose 0.3%, Melbourne was up 0.1%, whereas the other areas of focus at Brisbane, Adelaide, Perth were all significantly stronger over the quarter. And from a year-to-date perspective, Brisbane, up 30%, is still way ahead of everybody else. Now, how useful that is in terms of understanding what's going on is debatable. My own perspective has always been that the point about this index is that it's such an average that it really doesn't tell you very much about individual properties. But of course, it's still wildly reported in all the newspapers and online portals. Anyway, we'll keep an eye on it and see what happens ahead. It did disappear for a day or two, but now it's back. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.